Welcome back to the deep dive. For the last few years, we've been tracking this incredible rise of artificial intelligence.
And it's not just a sector anymore, is it?
No, not at all. It's become the fundamental infrastructure. It's everywhere. It informs how capital gets allocated. It's driving supply chains, and it's totally changing our definition of labor.
And, that creates this deep tension, especially in finance. If the entire market is moving at AI speed, at algorithmic speed, why are our main tools for evaluating a company's long-term value still looking in the rearview mirror?
Right. We're still relying on these old metrics, these models that are all based on historical performance, on ratios from a totally different era.
Pre-AI era.
Exactly. And that is the essential flaw we're here to dig into today.
So our mission for you is to really unpack a framework that's designed to fix this.
It's called the AI Future Fit Index, or AFFIO, and we're also going to look at how it's put into practice with the Human-Centric 60 portfolio, or HF60.
We're going deep on the ideology, the architecture, and then the actual implementation of this system, a system built for a future where AI informs our decisions.
And this is the key part. Humans stay firmly in control of the whole structure.
Absolutely. And it's really important to, give credit where it's due here. This framework is the creation of Levny Moten of N5 Digital, Inc.
And we need to be really clear with you as we discuss this. The names, AI Future Fit Index and Human Frontier 60, are both registered trademarks of Levny Moten and N5 Digital.
Right. This isn't just some marketing concept. The sources we have show that Mr. Nemotin is actually submitting a comprehensive paper on this whole system.
What's the title?
It's called AI Future Fit Index and the Human Frontier 60 Portfolio, a human-controlled, AI-informed, long-horizon portfolio management system.
And he's submitting it to the Journal of Portfolio Management,
which is a very prestigious, very technical journal.
So that tells you right away this isn't just a thought experiment. It's a framework that's being put up for serious academic scrutiny. It's moving from an idea to a rigorously tested methodology.
Which forces us to ask, what's the actual problem it's trying to solve? Beyond just, our metrics being out of date.
What is it?
Well, the source material says the core problem is really twofold. First, just the speed of change.
Right.
AI is becoming this general-purpose infrastructure, which means the market itself is accelerating. The old relationships between price and value and efficiency, they're being rewritten so fast that historical data just can't predict future success anymore.
So you could have a company that looks great on paper, historically, but if its internal structure isn't ready for AI disruption, its future is.
It's precarious.
Yeah.
Totally precarious. That's the time lag problem.
Okay, but you mentioned other systems trying to solve this, these AI readiness or AI maturity indices.
Yeah.
Where do they fall short?
They fall short because they're prescriptive. They are fundamentally human engineered from the top down.
What do you mean by that?
I mean, a team of experts gets in a room and says, okay, AI fitness is 40% data infrastructure, 30% executive buy-in, and 30% R&D spending. They define all the parameters, they assign all the fixed weights.
And the AI just acts like a scorekeeper. It just runs the numbers against the rules the humans made?
Precisely. And that's the huge vulnerability. Because if the market is shifting structurally, the things that define fitness today might be totally obsolete next year. That fixed, rigid, human-designed structure is just inherently too slow. It can't adapt.
It's like trying to navigate a modern highway system using a map from the 1950s.
That's a perfect analogy. And so the AI Future Fit Index tries to avoid that by asking the AI a different question. It's asking what parameters, weighted in what way, actually matter for long-term survival.
So that's the conceptual leap. We're moving from AI as a tool that just answers our questions.
Yeah.
To AI as a partner that helps us structure the right question in the first place. Okay, let's unpack that. This idea that the AFFI is designed to be AI native, not just AI assisted. I think for a lot of people that sounds a little scary.
You can, yeah.
If the AI is designing the rating system, how do we stop it from just becoming a black box that optimizes for something we don't understand, or maybe something that's ethically, compromised?
That is the central and totally legitimate fear. And the designers of this index are, from what we've seen, very focused on mitigating it.
Yeah.
Well, in a traditional AI-assisted system, the AI is, like we said, confined. It's in a box drawn by humans, just processes data and gets a score.
Right.
In this index, the AI operating within very clear human constraints actually participates in shaping the logic itself. The real novelty is that the AI proposes and justifies its own multi-factor rating architecture.
So wait. The human provides the goal-like, find long-term future-fit viability,
Right.
and the AI proposes the best map to get there, based on patterns that are just too complex for us to see.
That's it. The human validates the structure, but the AI discovers it. And this brings us right to the most important part, the crucial role of human control and governance.
It's right there in the name.
It is. Human-controlled, AI-informed. That control mechanism is the whole ballgame. It's what prevents the system from becoming some runaway optimization engine.
Let me play devil's advocate here for a second. If the AI proposes the factors, isn't there a risk it'll start to favor companies that are, I don't know, structurally similar to itself?
Yeah.
Or ones that just feed it the most data? You could get a self-reinforcing loop that's good for machines, but not for human values.
And that is the exact challenge the human control structure is designed to stop. The source material is very, very clear on this. Human oversight is authoritative through the entire process.
From start to finish.
From start to finish. Humans define the explicit constraints before the AI even starts working. These constraints include ethical boundaries, strict requirements for interpretability.
So you have to be able to understand why it made a choice.
Yes. And clear standards for accountability. So, for example, humans might tell the AI, you can optimize for organizational agility, but the factor structure you propose must not reward labor practices that violate human rights, and we must be able to audit every single step.
So the output, the rating system itself, has to be easy for a human analyst to interpret, to audit, and it has to align with our judgment.
Exactly. It's this blend of governance quality, ethical maturity, and human-centric design that stops the system from just defaulting to short-term financial wins or, technically perfect but socially toxic outcomes.
So the human role is to inject the long-term values into the DNA of the evaluation.
That's a great way to put it. Which brings us to how the AFFI actually defines future fit, because it's not just about profit or who has the coolest tech. It sounds much broader.
What is it then?
It is profoundly broad. Future fitness, in this context, means a company's capacity to remain economically viable, strategically relevant, and this is the really key part, socially authentic as AI reshapes everything.
Socially authentic, that's an interesting phrase.
It is. It's about durability and legitimacy. For a company to be future fit, it has to be able to adapt its business model, its workforce, its governance, all while keeping the trust of its customers and regulators.
And this is where the philosophy behind it all comes in, which I find fascinating. The paper introduces this foundational concept to anchor the whole thing. AI as human sum intelligence, HSI.
This is a critical reframing. It directly addresses that black box concern you had. The authors argue that the term artificial intelligence is actually misleading.
How so?
It implies this independent, almost alien intelligence, but the paper reframes AI as HSI, a summation and an acceleration of all of our collective human intellect, knowledge, and creativity.
So it's not some separate artificial thing. It's a hyper-efficient distillation of everything humanity has ever produced. All the data, all the science, all the history.
That's the idea. So if you're tracking, the HSI concept basically says AI is a very fast, very massive mirror of ourselves and our collective output.
It's built from our data, our designs, our processes. It's a cognitive amplifier that helps us see the patterns in our own complexity.
You got it. And that framing reinforces the entire architecture of the AFI.
How does it do that?
It clarifies AI's role. It's supportive, it's constrained. The AI proposes the structural map, but humans define the ethical guardrails. The AI does the heavy analysis, but humans interpret the meaning and add context. AI brings speed and scale.
But humans remain accountable for the outcomes.
Always. This isn't a battle of human versus machine. It's a disciplined partnership where the human side defines the values and the destination, and the machine helps find the most efficient route to get there. That's the philosophical pillar holding the whole thing up.
Okay, the philosophy is solid. Human sum intelligence, guided by human constraints. Let's get into the mechanics. To constrain the AI, the human experts have to provide these initial guardrails. These are the 5 criteria for selection.
Right. These are the conceptual boundaries, the non-negotiable elements a company needs to thrive in this new era.
They're the pillars the AI uses to evaluate fitness.
They are. Let's start with the first one, data and digital footprint. This seems obvious, but what does it really mean in practice for a big company?
Yeah, we always hear data is the new oil.
But here, it's more like the new soil. It's what everything grows from. This criterion looks at the depth, the quality, and the interoperability of data assets.
So not just having a lot of data.
Not at all. It means data that is well-governed, clean, constantly updated, and structured so AI models can actually use it to predict things. Think of a big healthcare provider that can connect patient outcomes with, say, regional weather patterns and socioeconomic data. That's interoperable, predictive data. That's a massive advantage.
Okay, that makes sense. Criterion 2 is AI capability and integration. This is about getting AI out of the lab.
Exactly. Out of the pilot phase and into the core business,
Mm.
it measures how deeply AI is embedded in core scalable functions, not just some flashy press release about an experiment.
So is AI being used for mission-critical stuff,
Yeah,
like supply chain forecasting or fraud detection?
precisely. Does it structurally transform their product or service? That's what this is looking for.
Third, human-centric design. This goes right back to the HSI idea and governance.
And this might be the most important one for long-term survival. It assesses if AI is being used to assist, not replace, human professionals. It demands explainability and trust.
The black box problem again.
Right. If an AI makes a call, a human needs to understand the logic so they can step in, audit it, and ultimately be held accountable. A company might have brilliant AI, but if it alienates its own workforce or can't explain its decisions to a regulator, its future fitness score is going to plummet.
Okay. Criterion 4, the adaptable operating model. This sounds more like culture than tech.
It is. It's about organizational agility. It focuses on having modular systems so you can upgrade one part of the business without the whole thing falling apart, and a culture that's built for rapid reskilling.
Because the market is always going to pivot.
The market will always pivot, and if your organization is too rigid, even the best AI won't save you.
And finally, number 5, regulatory and ethical maturity. This seems like a direct check against just chasing profits.
It absolutely is. It measures the ability to comply with all the emerging AI regulations around the world, manage sensitive data responsibly, and, maintain public trust.
This is a huge deal as fairness and bias mitigation become central.
It's essential. Companies that are proactive about this are just structurally more resilient. So these 5 criteria, together, they define the sandbox that the index operates in.
Okay, so that's the how. Now let's look at the where, the 6 core sectors of the future economy. The index groups everything into these broad domains.
And it ranks them based on a composite score. It looks at economic weight, employment intensity, systemic leverage, societal impact, and, of course, how transformable they are by AI.
So the ranking is about foundational necessity, not just current market cap.
Exactly. It's about what's crucial for a stable, functioning hybrid human-AI civilization over the very long term.
And at number 1, the most structurally important sector, according to this framework, is human services.
Yeah. Healthcare, education, retail, hospitality.
This is the biggest share of GDP and jobs globally.
It's number 1 because of its sheer scale and the direct need for human trust. The role for AI here is augmentation, not replacement. Think personalized learning plans for students or incredibly precise clinical decision support for doctors.
So it's about getting better outcomes per human professional.
Yes, because the core human elements, empathy, hands-on care, complex social judgment, you can't automate those. That makes the human element in this sector an enduring source of economic value.
Okay, number 2 is foundational production and infrastructure. Manufacturing, construction, energy, logistics, the physical backbone of everything.
This sector has immense systemic leverage. If the power grid fails, the digital world just stops.
So AI's role here is precision and efficiency.
Predictive maintenance, generative design, real-time grid optimization. You still need human experts for safety and oversight, especially as these systems get more and more complex.
Number 3, finance and capital allocation, banking, insurance, asset management.
This one is critical because it influences every other sector. AI's main role here is still risk modeling, fraud detection, credit analysis.
The stuff they were early adopters on.
Right, but at a whole new scale. Still, humans have to retain oversight for compliance, for ethical judgments, and for managing systemic risk.
So the index would favor a bank using AI for governance, not just for high-speed trading.
Precisely. 4th is knowledge, R&D, and advanced technology. Universities, labs, biotech, software.
The engine of growth.
This is the intellectual core. AI acts as a high-bandwidth cognitive partner here. It accelerates scientific discovery, it generates code, it helps design new drugs, but it completely relies on human creativity to form the hypotheses in the first place and to interpret the results.
Number 5, government, governance, and public services.
Crucial for social stability. This sector sets the rules for AI itself. Its systemic leverage is unmatched. AI's role here is very constrained, focused on efficiency things like policy simulations or optimizing city services.
But deployment has to prioritize fairness and accountability above all else.
Absolutely. And finally, number 6, media, communication, and entertainment.
The cultural influencers.
Exactly. Telecom, streaming, publishing. AI helps with recommendation engines and content creation, but maybe most importantly, with the infrastructure needed for deepfake detection and moderation.
Why is it ranked last?
Because while it's highly visible, its direct systemic leverage on, say, energy or finance is lower than the other 5. But maintaining trust in information is its unique, invaluable human frontier.
It's fascinating. The sources even suggest that this analysis points to the emergence of totally new kinds of organizations. Things like AI-enabled microschools or AI-orchestrated microfactories.
And those aren't just buzzwords. They're like organizational blueprints that perfectly fit those 5 criteria we talked about. An AI-orchestrated microfactory isn't just automated, it's modular, it's adaptable.
And it requires highly skilled humans for oversight and optimization, reflecting that adaptable operating model criterion.
You got it. They're the practical result of applying this logic to the real world.
So we have the philosophy, the AFFI, and the structural map of the 6 sectors. Now we get to the practical application. How do you turn this rigor into something you can actually invest in? This is the Human Frontier 60 portfolio, HF60.
Right. This portfolio is the first practical application. It translates that future fitness evaluation into a diversified portfolio of 60 public equities drawn from those 6 segments of the economy.
And the goal here is long horizon exposure. We're talking 25 to 50 years.
Yes, it's about reflecting that ongoing structural economic transformation, not chasing short-term market noise.
And the investment philosophy here is really interesting because it kind of pushes back against the idea that you have to bet on tiny disruptive startups to win in AI. This portfolio avoids speculative IPOs.
This is a huge strategic anchor for the whole thing. The philosophy is built on the premise that the real innovation in the AI era, all the new models and applications, will ultimately be absorbed, integrated, or acquired by established firms.
Why?
Because those firms already have 3 critical things: scale, governance maturity, and capital durability.
So they're betting on the sophisticated user and integrator of AI, not necessarily the small, specialized producer.
Exactly. They are sacrificing that speculative, high-volatility IPO pop for what they see as superior long-term compounding from established firms who can actually implement and scale innovation transparently.
So a big industrial automation company that's truly AI-ready is a better long-term bet than a niche AI startup whose whole existence depends on the next tech breakthrough.
That's the argument. It's an investment in institutional readiness filtered through those 5 A4 criteria.
And the portfolio grounds its capital allocation in what it calls the 5 human frontier zones. These are the ideological pillars, right? The areas where humans have a durable advantage.
These zones define the structural categories of competitive advantage for the next few decades.
Okay, let's run through them. First is trust, so care, health, services. Things that rely on empathy in complex human context.
Things that can't be automated. Second is embodiment. Physical work, robotics, complex manufacturing. AI makes it more efficient, but humans provide the ethical framework and safety oversight.
Third is meaning. Culture, education, narrative. AI can generate content, but humans define the artistic intent, the cultural legitimacy.
Fourth is responsibility. Governance, compliance, cybersecurity. As AI makes things more complex, you need human authority for legal and ethical control.
And fifth, the engine for all of it. AI and robotics leverage. The compute, the cloud, the automation that powers the other 4.
And when you combine those 5 zones of the 6 sectors, you get this asymmetrical sector weighting. This is the most fascinating part of the portfolio's design.
It's intentionally unbalanced.
Very. It allocates capital based on the projected dominance and structural necessity of each domain in a hybrid human-AI civilization over the next 25 to 50 years. It reflects these deep macro trends like an aging population and the massive energy needs of AI.
Okay, let's break down the weights. They tell a story. The heaviest allocation, a full 25%, goes to AI infrastructure and computing.
This is the biggest piece because it's the most critical structural bottleneck. AI requires exponential compute power. This is the picks and shovels of the AI gold rush.
So we're talking about companies like NVIDIA for the chips, TSMC for manufacturing.
Yes, but also the big cloud and enterprise AI stack providers, Microsoft, Alphabet, Amazon, Their scale makes them the horizontal enablers for every other sector. That 25% allocation is a structural bet that the hardware, the energy, the cooling, that demand will drive massive capital spending for decades.
It's a bet on the utility provider of intelligence.
That's a perfect way to put it. The second largest segment is healthcare, trust, and human services at 22%.
Which is almost as big as the infrastructure itself.
And that weighting captures the macro tailwind of demographic aging and the enduring economic value of human empathy. We're talking about companies like United Health Group or Elevance Health. They're chosen because they have massive proprietary health data sets and use AI for optimizing care. But the final delivery of that care remains human-led.
So the framework is saying that the necessity of human-delivered care is almost as structurally important as the computing power.
It is, because it's inherently recession-resistant and driven by demographics. Next up is enterprise platforms, governance, and responsibility at 19%.
This is the scaffolding.
The scaffolding for a human-led market. It's AI, safety, compliance, workflow management, cybersecurity. As regulatory complexity explodes, this layer becomes non-negotiable.
So firms that manage the complexity AI creates, like Accenture for strategy and governance, or Palo Alto Networks for cybersecurity.
Exactly. And if you add those three up, compute at 25, human services at 22, and governance at 19, that's 2/3 of the entire portfolio.
36%.
Yeah. It highlights the core logic. The future economy is dominated by the tools of intelligence, the necessities of human life, and the systems needed to govern both of them safely.
Okay, moving down the list. Robotics and autonomous systems gets 18%. This is the physical automation stack.
Right.
Why is it a bit lower than governance?
Robotics is essential, for sure. But the 18% weighting acknowledges that full deployment is often very capital-intensive and subject to longer regulatory cycles than pure software.
So it's a slower burn.
A slower burn. This includes big industrial players like Siemens and ABB, or specialized firms like Intuitive Surgical, and even a company like Tesla, specifically for its potential in general-purpose humanoid robotics.
The fifth segment is energy, power systems, and industrial backbone, at only 10%. Now wait, that seems low when we just allocated 25% to the compute that needs all that power.
That's a great question, and it shows a really nuanced understanding of the structure. While AI needs massive energy, the portfolio assumes that the highest value capture will be in the specialized infrastructure, that 25% hardware and cloud layer, not in the commodity power generation itself.
Ah, okay.
So that 10% is targeted at the transformation of the grid. Companies like NextEra Energy, focused on renewables, or Schneider Electric for energy management. It's an exposure to electrification and efficiency.
And finally, the smallest segment, at just 6%, meaning media, education, and culture.
This reflects the enduring human advantage in identity, narrative, and cultural legitimacy. While AI can help create content, the fundamental decisions about vision and artistic merit remain high-value human activities.
So Disney, Netflix, even Duolingo for human AI learning.
Exactly. The smaller weight just reflects that this segment is often more fragmented and subject to rapidly changing tastes, so it's structurally less durable than, say, healthcare or infrastructure.
So if you look across all 60 firms, they share these common strengths. Massive data flows, strong governance, high regulatory compliance, and a multi-decade advantage. It's a bet on institutional readiness.
And that readiness is constantly being measured against those 5 structural criteria we started with. That's the engine.
Okay, this incredibly detailed structure raises a huge governance challenge. How do you manage a forward-looking portfolio like this without letting it become a high-frequency trading black box that's just reacting to every little market dip?
So that's where the human-led maintenance philosophy comes in. And the core idea is that maintenance is structural, not reactive. Meaning adjustments are driven by changes in the underlying structural conditions, not by short-term market noise or valuation swings.
So if a company in the portfolio has a bad quarter because of a supply chain issue, that's not enough to get it kicked out.
Not at all. But if that same company has a massive data breach and loses its proprietary assets, or if its board completely abandons its commitment to human-centric design...
That's a structural change that warrants a reassessment.
Exactly. The maintenance philosophy dictates that everything remains explicitly human-led, just supported by AI analysis. And crucially, every change requires human judgment, which has to be documented.
Creating an auditable trail.
A critical auditable trail. You have to reference which future fit criterion was violated and provide a clear rationale.
That makes sense. But what about the constraints on the human managers? What stops someone from just overriding the AI structure because they have a hunch about a stock?
The rules are designed to be highly constrained to prevent exactly that kind of discretionary trend chasing. Formal reviews only happen semi-annually, and human judgment can only intervene under defined extreme conditions.
Like what?
Like if the AI model's confidence scores are suddenly very low,
Hmm.
or there's a huge corporate event like a merger or spin-off that totally changes the company's focus, or if they identify a model blind spot where the AI's logic looks sound on paper but is structurally flawed in reality.
An override is a serious logged event.
A very serious event. Every single one has to be documented with an explicit justification. It's the ultimate check and balance.
Okay, now for what I think is the most provocative part of this whole thing,
Yeah.
the validation philosophy. Specifically, this controversial idea that traditional backtesting, using historical market data to prove a model works, is a category error.
This is a radical but I think necessary intellectual departure.
It's huge.
It is. If you're designing a portfolio for a structural transformation that hasn't finished yet, this shift to AI as infrastructure, you can't expect to validate it using data from the pre-AI era.
So forcing a future design strategy to optimize for the past is basically training it to fail in the future.
That's the argument. It's a category error. The category of the market itself has changed.
Okay, but if you throw out traditional backtesting, which is the cornerstone of quant finance, how do you validate the approach?
The validation shifts focus. Instead of predicting price movements, it assesses logical coherence, robustness, and structural adaptability.
How do you test for that?
They use simulations against prior technological regime shifts. So they apply the index's logic, the 5 criteria, the asymmetrical weighting retrospectively to periods like the internet boom in the late 90s or the mobile and cloud transitions of the 2010s.
And what are they looking for in those simulations?
They're looking for internal consistency. Did the index correctly identify the firms that had a superior data footprint and an adaptable model during those transitions, even if their stock price was volatile? Did it correctly weight the infrastructure providers, like Cisco back then, over the speculative companies that ended up failing?
So it's not about predicting a specific rate of return. It's about showing that the index's logic for identifying durable structural winners holds up across different cycles of technological adoption.
Exactly. Success is measured by its ability to identify organizational survival and transformation, not just maximizing a sharp ratio over the last 5 years.
So what does this all mean for you, the investor? The AFFI and HF60 area, they're not meant to replace traditional financial metrics, are they?
Not at all. They augment them. They provide this new structural layer of analysis. It's a tool for asset owners with the longest horizons, pensions, endowments, sovereign wealth funds who are thinking about the next 25 to 50 years.
So for those investors, it changes the questions you ask. It's less about short-term momentum and more about a company's data governance, its auditability, its human-centric design.
Right. It helps you assess not just what a company did last quarter, but whether its structural DNA is compatible with a human-led, AI-powered future. It's about aligning your capital with the actual architecture of the future economy.
Wow. We have taken a deep dive today. We've unpacked the whole methodology of the AI Future Fit Index, or AFA, how it's AI native, moving the machine from just scoring to helping design the architecture itself, all under strict human control.
And we looked at its direct investable application, the Human Frontier 60 portfolio. A portfolio strategically weighted toward what this framework sees as the structural necessities of a hybrid human-AI civilization.
Prioritizing that foundational compute infrastructure, the enduring human services, governance, physical automation, all based on those long-term macro trends.
And the whole system is anchored by that central idea of AI as human sum intelligence, an amplifier and a reflection of our collective knowledge, but one that has to be governed.
So if we accept that framing, that AI is the acceleration of our collective knowledge, that the real challenge for you, the learner, isn't just keeping up with the machine's speed.
No, the structural challenge is for you to constantly and ethically define the boundaries, the values, and the fundamental questions that the machine must be constrained to answer.
What unique role of human judgment, empathy, or creativity will you define as truly irreplaceable in the decades to come? And how will you ensure those values are embedded in the systems we build and the investments we make? That is the essential frontier we all have to navigate.